Hello, in this video we'll consider the effect of the Qualified Business Income Deduction on business entity planning and business entity choice. Now, this video assumes that you have a basic knowledge of the Qualified Business Income Deduction, and if you have not yet looked at the Qualified Business Income Deduction, I recommend stopping and watching my video on Qualified Business Income Deduction Basics, because that goes through the basic discussion of the Qualified Business Income Deduction. This is meant to talk about business entity planning, S corporations versus LLCs versus C corporations, and how, when we look at business entity choice, how the Qualified Business Income Deduction makes a difference in that analysis. Whether it's determining between a C corporation and the LLC versus the S corporation, or if you're just simply between the LLC and the S corporation because you've eliminated the C corporation as an option. So let's go ahead and let's talk about entity planning. And again, it's important to remember that when you're looking at entity planning, you've got to remember these basics of the Qualified Business Income Deduction. As I mentioned in the mechanics video, I talked about history. And the big push for why we have this provision, in a little nutshell, is because the corporate tax rates were reduced. They reduced dramatically from 35 to 21% under the Tax Cuts and Jobs Act of 2017, starting in 2018. And this provision was to level the playing field for the pass-through, flow-through entities. That's the idea. So before the Tax Cuts and Jobs Act of 2017, business entity planning or choice of entity was very, very, very basic, and it was very rare to find a time when you needed a C corporation. There were some instances where, okay, well, if you retain earnings, don't have to worry about the accumulated earnings tax because the corporate tax rate is lower than the highest ordinary income tax rate. You could potentially save taxes there. Also, maybe you step up basis type rules with 1014 estate planning concepts with respect to the retaining your earnings in the corporation. Also, financing, because some types of venture capital angel investors prefer you to be in a C corporation, so you can, so it's easier to get financing and it helps them out with respect to tax issues. Those are the kind of reasons why you might take advantage of a C corporation over S corporation or LLC. Well, after the Tax Cuts and Jobs Act of 2017, with a lower C corporation tax rate, very much lower, C corporations become very enticing. But remember, the Qualified Business Income Deduction under Section 199 Cap A, what we're talking about in this discussion, was enacted to level the playing field. So a lot of times, it still makes the most sense to operate as an S corporation or LLC because you can still get that Qualified Business Income Deduction. Now, if you're in an area where the Qualified Business Income Deduction is not going to be maximized, maybe because you don't meet the wage and property limits, but you know you're going to be in that category, like situation number 6 for a qualified trade or business, but you know you're not going to be able to plan around that because you lease property or something like that, or you don't have any employees, then maybe it is best to go in a C corporation because you do get the 21% rate versus the 37% ordinary income tax rate, and you don't get the Qualified Business Income Deduction. But if you can get the Qualified Business Income Deduction and you can maximize that optimally, which we'll talk about with the deductions, with the wage and property limits, some ways to do that in income planning, it makes the most sense to stick with the S corporation or LLC. Not everybody, but most of the time, you're going to see after the Tax Cuts and Jobs Act of 2017. So really, after the Tax Cuts and Jobs Act of 2017, it still is the same result. A S corporation or LLC is usually the best result because you can always change to a C corporation with not many tax consequences in the future versus going the other way. Switching from a C corporation to a S corporation or LLC is very difficult. After the Tax Cuts and Jobs Act 2017, S corporation and LLC are very enticing still, but I will say that after the Tax Cuts and Jobs Act of 2017, with the corporate tax rate being lowered, you do have to dive deeper into the business to see what's going on and make sure that the QBID, the Qualified Business Income Deduction, can be maximized to get that benefit. Specified service trade businesses probably belong in an LLC. It's probably the best case when you're looking at the Qualified Business Income Deduction. So I want to illustrate through an example. So assume we have accountants X, Y, and Z. And accounting, as we know, is a specified service trade business. And they want to form a new accounting firm, and they want to maximize the likelihood of qualifying for the Qualified Business Income Deduction. So assume that in 2018, they're calendar year taxpayers, let's say. The firm expects to distribute $1 million, or it's allocated out, I should say. It's allocated, distributing cash, but it's also allocated. These amounts are allocated. $1 million in 2018. So they have $1 million in income that's allocated out. And X will be allocated $500,000. Y and Z, though, will each be allocated $250,000. So $500,000, $250,000, $250,000, $1 million when you add those up. Now, X and Y are married filing joint with their spouses. Z is single. So assume someone are officially that they're only service providers in the business. They're the only ones, okay? They're the only 3 service providers in this accounting firm. And that there's no W-2 wages paid. All right, that's very important. So if they choose to be an S corporation, then X, Y, and Z, under the rules for S corporations, for reasonable comp for corporations, you're going to be required to make some type of compensation payment, a reasonable amount to each owner, to X, to Y, and to Z. Okay. Now, what that amount is determined based on the facts and circumstances. We're not going to go into that. But the important point is that there will be some type of compensation that has to be taken out. And if you remember from our mechanics discussion, the previous video, the amount of qualified business income, right, which is what creates the deduction, right, 20% of the qualified business income. Well, the amount of qualified business income does not include W-2 wages paid to the taxpayer. So the amount that X, Y, and Z are deemed to have reasonable compensation from the S corporation, if they choose to be an S corporation, that would not go in qualified business income. However, if X, Y, and Z choose to be an LLC, well, guess what? LLCs, under the partnership tax rules, they actually cannot pay any W-2 wages to themselves. They're generally barred by the IRS rulings from being employees of a partnership in which they are partners. So there will be no W-2 wages paid, right? And they don't have any employees, so they can't pay wages to anybody anyways. And remember that guaranteed payments don't count as well. But let's say there's no guaranteed payments, there's no W-2 wages in LLC. So what ends up happening is this increases the amount of qualified business income for X, Y, and Z. So if we continue with that reasoning, continue with the choice of the LLC, then what you're going to see is that X, because X is married, filing joint, and has $500,000 in partnership income, likely X will exceed the maximum threshold amount of $415,000 in 2018, depending on your year. So therefore, X, because it's a specified service share business, X won't be able to get the deduction. Same thing for Z. Z is single, and Z gets $250,000, which is likely more than the maximum threshold, which in 2018 is $207,500. Again, inflation adjusts in the future when you're watching this. So X and Z can't get the deduction. But what about Y? Y gets $250,000, and let's assume that Y's spouse doesn't really have much additional income. Well, the threshold amount was $315,000, the initial threshold. And because the initial threshold is $315,000, then Y can get that deduction and of 20%. So operating through an LLC, Y gets to maximize the QBI because that $250,000 of QBI, we take that times 20%, which is $50,000. If this was an S corporation, and let's say that Y was deemed to pay through the reasonable compensation rules $100,000, it would only be $150,000 times 20%, which would be $30,000. So that makes a big difference, okay? That makes a big difference. So so you're talking about $30,000 versus $50,000 in terms of operating through an LLC. Makes a big difference. Big difference. And if you're looking at multiple years, that's obviously, if Y, let's say, has an effective tax rate on that amount of 30%, you're talking about saving each year about $20,000 difference, $30,000 versus $50,000. So $20,000 times, let's say, effectively, again, 30% tax rate, to my $6,000 savings in taxes each year by getting the deduction. The difference between, I'm talking about the difference, not the actual, the $50,000 times 37 would be $15,000 benefit to Y. But I'm talking about if it was an S corporation, and again, let's just say Y had reasonable compensation under the rulings to be $100,000, well then only $150,000 would be qualified business income. $150,000 times 20% would be $30,000. So that $20,000 difference, 50 for LLC versus 30, $20,000 difference, multiply that by 30% tax savings, tax rate, that would give a $6,000 benefit. And if, again, that can go for many years. That could go for 20 years, talking about $120,000. So that's why being an LLC for a specified service share business makes a big deal. Because And the reason for that is because with an LLC, you can't pay yourself wages. So if you recall, if you're a qualified trader business, you want wages because of the wage and property limitation. And this potentially could get into a negotiation as well. If this was a qualified trader business, Y would want to be an LLC, but X and Z would want to be here an S corporation, because their amounts would be above the threshold plus amounts, and then they would want deemed compensation to an S corporation, so that way they could get the benefit of the wages for their allocable share, so they can maximize the amount, or at least get some deduction. Do you see how that works? This actually creates a negotiation issue, a very interesting negotiation issue. X and Z would want to be an S corporation because of wages. X and Z want wages because of the wage and property limits because they're above, but Y would not want to be an LLC because they don't want any wages and they want to make sure they maximize their QBI.